Well, I think the recovery that we've seen in the United States has perhaps been a little bit more volatile than we would have anticipated. The expectation is actually the US economy contracted in the first quarter of this year, although there are some issues around the seasonally adjusted data that officials have been looking at. But we have seen a raft of disappointing data in the first 3 months of the year. But I think the outlook for the US economy as we go through the rest of 2015 into 2016 starts to pick up. We know the US economy will benefit from a pickup in both internal and external demand. The great debate that's taking place in the markets at the moment when it comes to the United States is when will we see the first rate rise coming through from the Federal Reserve. Remember, the Federal Reserve has kept rates on hold now since December 2008, but real pressure has been building on them. And the expectation is, if you look at the latest minutes from the Federal Reserve, is I think we're likely to see that first rate rise coming through in September. Some market participants have suggested June is possible. I think that's unlikely, given the fact the Federal Reserve back in March downgraded its forecast for economic activity and inflation expectations. I think they're likely to hold off. We think we'll see 2 rate rises from the central bank during the course of this year, Fed funds finishing the year between 50 and 75 basis points. Then we really have to ask ourselves, of course, is the US economy strong enough to withstand this normalization of interest rates? The first place you look for evidence of that, I guess, is the labour market. The labour market has been the driving force behind Federal Reserve policy. Unemployment has fallen dramatically in the United States. Think about it. Unemployment peaked in October 2009 at 10% during the course of this cycle. Today it's down to 5.4%. If you look at the non-farm payrolls, good number last month. The expectation is, on average, that the economy will create between 200 and 225,000 jobs per month, pushing down that unemployment rate to a level that the Federal Reserve believes is pretty much full employment, which is, I guess, is close to around 5.1%. Retail sales numbers have been disappointing. We know how important the US consumer is in terms of the economy. A little bit of a slow start to the year, but given unemployment is falling, wages are starting to rise. Of course, petrol prices have come down, which have been boosting disposable income. I think the consumer will continue to be supportive of the economic recovery. House prices are worth watching. House price inflation has slowed down quite dramatically. A year or so ago, it was running around 13-14%. The latest figures have got annual house price rises at 5%. And house prices play an important role in terms of the psyche of the consumer. House prices are rising, they feel wealthy, consumers are out there spending money. So I think that's well worth watching. But the reality is, when you look at a broad range of measures for the US economy, it tells you quite a bright picture. Look at the ISM surveys, give you a guide to future demand, both manufacturing, non-manufacturing. Those order books look healthy. Remember, manufacturing higher today than where it was before the financial crisis. Household wealth is higher today than where it was before 2007. Productivity is rising, unemployment, as we said, is falling, retail sales are likely to pick up. So we are optimistic about growth from the US economy. Perhaps not as optimistic as we were at the start of the year, but we still think the US economy will grow around 2.5% during the course of 2015. Well, the other big focus for market participants during the course of this year is what's happening within the Eurozone. We know the restructuring process continues to take place, perhaps a little bit slower than we would have liked, but markets have remained relatively calm, benefiting from the work done by politicians and by central bankers. We know that politicians have been reforming their finances, restructuring their economies. Central bankers have been playing their part, doing their bit to put the safety net in place to give politicians the time that they require to come through. That's not to say that the European crisis is over by any means. We know we've seen a social backlash to the reform programme that's been put in place, which is perhaps no real surprise given the fact that we've only seen anemic economic growth at best in the past couple of years. There's austerity fatigue. Remember, unemployment in the Eurozone still remains elevated, still above 11%. So there is a potential for that to slow down the timetable of change. Policymakers are concerned about the lack of credit flowing through from financial institutions to small and medium-sized companies. The number one threat really for policymakers, at least in the short term, has been the threat of deflation within the Eurozone. inflation turned negative back in December, has stabilised a little bit in the past couple of months. And that's not simply been driven down, as we've seen in other regions, by lower food and fuel prices, but it's fundamentally weak demand, and that's why it's been such a concern. But of course, the European Central Bank has been reacting to those conditions, cutting interest rates down to a historically low level, 0.05%, became the first major central bank to introduce a negative deposit rate on commercial banks that park their money at the central bank, outlining a huge targeted long-term refinancing operation in an effort to improve liquidity at financial institutions, and of course said that they would buy asset-backed securities and covered bonds. But the reality was, and we saw that at the start of this year, that was not enough to reflate the economy, to generate the job opportunities it requires, to stimulate the growth that's needed in the Eurozone. So what did we see? Well, we saw the European Central Bank reaching for the big bazooka. The big bazooka is this stimulus program. European Central Bank saying that by 60 billion euros worth of bonds every month until the end of September 2016. So starting in March of this year, and that equates to a stimulus program of more than 1.1 trillion euros. In fact, they say they continue to buy at that level until inflation level picks up. So we wait to see exactly how that plays out. So what are they hoping to achieve through this stimulus program? Well, quantitative easing does what it says on the tin, increasing the quantity of cash that's flowing through the economy. We know that they're looking to improve liquidity conditions within the financial services industry. Alongside that, keep the borrowing costs down, not so important for core European countries where borrowing costs are very low, far more important for indebted southern European countries. Keep the cost of borrowing low for companies as well. But this should really be seen for what it is. This is an aggressive move from the European Central Bank to devalue the euro. You devalue the euro, you automatically boost demand for European exports, and that's exactly what we've been seeing. Will it work? Well, I think it will help to re-anchor inflation expectations, it will help to reinforce forward guidance, and also lift growth prospects within the Eurozone as well. We're probably talking about growth of just over 1% during the course of this year. But we should also remember, this is not the silver bullet that solves the European sovereign debt crisis. As Mario Draghi, President of the European Central Bank, said, we've done our bit, now it's back to political leaders to push through that reform agenda. I think there's some key areas that they need to focus on. They need to improve flexibility within the labour market. They need to reduce the power of the unions, change the labour laws, change the taxation and benefit system. I think they need to create a more competitive environment. They need to create a more dynamic economy as part of that process, driving up productivity. Alongside that, a more entrepreneurial society within the Eurozone, greater incentives for business to invest and to innovate, more grants for research and development, but also reducing the bureaucracy, the regulatory hurdles, particularly for small and medium-sized companies. If you look at the Eurozone, yes, growth has stabilised. It's starting to pick up a little bit, but the economy is still smaller today than where it was before the financial crisis. Confidence is very, very low indeed. Business confidence, business investment is very poor. Household demand, much lower than we'd like to see. It will take time for that to turn around. When you look at Europe, we don't think it's going to break apart. But as Martin Wolf said, Europe is a bad marriage. It's going to stay together. It still needs an awful lot of help to get it to a point where it's starting to improve from here. So the European system staying together, slowly but surely getting stronger, but it'll take some time for that to happen. I think it's going to be a more challenging environment for managers of captive funds from an investment perspective than we've seen over the course of the past couple of years. We know traditionally captive investors have used quality government bonds, and in the past that's generated the returns that have been required. I think the reality is government bonds have performed much better than most investment analysts have been anticipating over the course of the past few years, benefiting from slower growth that we've been seeing, lower levels of inflation than was anticipated, far more aggressive stimulus programs, quantitative easing programs coming through from central bankers, and the fact that interest rates have been kept much lower for much longer than was anticipated. But I think the world is starting to change. Growth will start to pick up. We're already starting to talk about, at least in the United States, the normalization of interest rates coming through, and of course a pickup in inflation expectations as well. And that will have significant negative headwinds, I think, for quality government bonds. So it's about getting that balanced portfolio right. Now, we know that traditionally captives have been concerned about putting their money into equity markets, even though they're long-term investors, and we know that actually equity markets do perform better than other asset classes over a prolonged period of time. So I think what we should really appreciate from an investment perspective is it's about getting that balanced portfolio right and how much equity you should have within that portfolio. Equities are the most volatile of the liquid asset classes, offering the greatest opportunity for profit, but also risk of loss. I think what we should remember is there is a higher risk involved. There is greater volatility coming through. But even when you look at the boring old US stock market, it's outperformed most markets in most currencies for most of the past 30 years. The reality is if you want the opportunity for higher risk-adjusted returns in a low interest rate environment, owning a slice of a publicly listed company has to be part of that solution. I still think the fundamentals for equity markets still remain strong. If you look at earnings growth, still remains robust. Valuations aren't expensive by historical standards. The dividend yield that you receive is still very valuable in this current environment. But what we've been saying to investors that have been looking at equity markets in the developed world, it's not all about the United States. Past few years we've said US, 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 put your money there. That's where we've seen the outperformance. Now we believe there's greater opportunity. You should be looking to increase your exposure geographically to include Europe as well. That was our call coming into this year, and we've seen significant outperformance from European markets. So it's about by being diverse within developed market equities, but also making sure your equity weighting is correct as you start to see this change in dynamics taking place. Government bonds coming under pressure, something we haven't seen for a long time. Equity markets, we still believe, will be outperforming longer term.